I'm Jack.
And I'm Misha.
Welcome to today's deep dive. We're really thrilled to have you with us today. Usually when you think about massive corporate growth, there's this underlying assumption of like financial gravity.
Right, the traditional rules of business physics.
Exactly. If you want to build a behemoth of a company, the old rules basically dictate that you need heavy machinery, massive physical assets, huge data centers, and almost always this enormous anchor of debt dragging behind you. It's that industrial mindset, right? If you want to build a giant, you have to borrow like one.
Yeah, the old model of making money demands that you buy things, own things, and leverage yourself to the absolute hilt against those things. It's a framework built entirely on friction, weight, and risk.
Right.
But then you step into the world of pure digital ecosystems, and suddenly, it's like someone simply turned off the gravity. We're looking at a financial landscape today that completely defies those 20th century laws of physics.
Which brings us to the stack of sources we're pouring over today, centered entirely on the 2025 annual report for Rasan Information Technology. For those of you who might be, new to the name, Rasan is a Saudi-based digital insurance and fintech giant.
A massive one, yeah.
And our mission for you today is very specific. We're going to unpack exactly how a technology company serving over 12 million customers managed to achieve hyper-exponential profit growth in a single year. And they did all of this while operating completely, 100% debt-free.
And we really need to emphasize that phrase hyper-exponential here. Like, we aren't using that lightly. We are looking at a staggering 161% jump in net profit from 2024 to 2025.
It's wild.
It really is. They're scaling to billions of dollars in transaction volume without ever actually holding the bag of risk. It's the absolute definition of an asset-light masterclass.
Okay, let's unpack this, because before we can even begin to dissect a massive financial leap like a 161% profit jump, we need to strip this down to the studs. Like, what is the actual ecosystem here? What exactly is Rasan selling, and who's actively buying it?
Well, at its core, Rasan operates as an insurance aggregator and broker. They sit directly in the middle of the market, primarily operating through two massive, distinct platforms. First, you have Tamini, which is their business-to-consumer, or B2C, platform.
Okay, the consumer side.
Right. And Tamini is an absolute behemoth in the region. It caters directly to a base of over 12 million retail customers. Just to give you an idea of their sheer dominance, they hold a 43% market share in online motor insurance in the kingdom.
Wait, let's just pause on that number for a second. 43%. That means out of every 10 cars you see driving down the road, more than 4 of them were insured through this specific digital platform.
Yeah, it's huge.
That is just a staggering level of market penetration. So that's the consumer side. What about the second platform?
So that is Treza. Where Tamini is for the everyday consumer, Treza is their business-to-business, or B2B, arm. They cater to corporate clients, finance companies, and major banks.
Oh, interesting.
Yeah, perfect example from the 2025 report is their massive technical integration with the Saudi National Bank, or SNB. They effectively transferred the bank's insurance services directly onto the Treza platform to streamline the entire process for SNB's financing customers.
So to put it in perspective for you listening, it's a bit like a digital travel aggregator. Think of like an Expedia or a Kayak. But instead of booking a weekend vacation, you're managing mandatory life logistics.
Exactly.
But I do have to push back here for a second. If Rasan is just the middleman, taking a cut of the transaction, how do they capture almost half the market? I mean, why wouldn't those 12 million people just bypass the app, go straight to the insurance providers, and cut out the middleman entirely? If it's just a portal, where is their actual moat?
It's a completely valid question. And the answer comes down to the concept of friction, or rather, Rasan's hyper-efficiency at eliminating it. Historically, think about what getting insurance meant.
A headache, mostly.
Right. It meant dealing with opaque pricing, calling different brokers, slow approvals, and just endless repetitive paperwork. What Rasan actually offers is speed and AI-driven pricing transparency.
Meaning they aren't just giving you a static list of prices like a digital bulletin board.
Exactly. Their AI models actually optimize the pricing and risk assessment in real time. By analyzing vast amounts of data, their algorithms help match the exact right risk profile with the exact right insurer instantly.
Oh, wow.
This creates better conversion rates for the insurance companies and cheaper, faster options for the consumer. Plus, in 2025, they completely transformed Tamini. It's no longer just a comparison site where you click a link and get redirected somewhere else.
So what is it now?
It is a fully integrated digital insurance ecosystem. You buy the policy, you manage it, you renew it, and crucially, You file your claims all within their proprietary app. They haven't just captured a transaction, they've captured the entire customer journey.
So looking at Tamini and Treza together, I'm noticing a pattern in their product expansion. They were traditionally known for motor and health insurance, right? But looking at this 2025 report, the scope is really aggressive.
Oh, completely.
They're now selling home insurance, marine insurance, travel insurance, and even protection and savings plans. They aren't just trying to acquire individual customers, they're actively trying to embed themselves into the infrastructure itself.
Precisely. And they are moving into highly specialized vital niches to do exactly that. For example, they won a tender to provide domestic worker contract insurance directly through the government's Musan platform.
Okay, remind me what Musand is.
Musan is the official digital platform managing domestic labor in the kingdom. By integrating there, Rasan becomes the invisible plumbing for a massive national logistical framework.
That's incredibly smart.
They've also rolled out medical insurance specifically tailored for premium residency holders. So they are weaving themselves into the very fabric of how logistics, labor, and residency operate in the region.
They're basically positioning themselves to be everywhere, but serving millions of users, building all these new product pipelines, and running API integrations with massive national banks usually, that requires a massive amount of overhead.
Right.
You need huge development teams, servers, and, like we talked about at the top of the show, a mountain of debt to finance that kind of aggressive expansion. But Rasan somehow avoids that trap. Let's talk about their secret sauce.
What's fascinating here is the structural beauty of their balance sheet. It all comes back to that asset-light business model we touched on. You have to remember, Rasan does not carry what is called underwriting risk for any of the insurance policies they sell.
Hold on, let's clarify underwriting risk for a second, because that's a crucial distinction. Essentially, if you buy a comprehensive car insurance policy on the Tamini app, and the next day you total your car in a massive accident, Rasan does not pay for your car.
Correct. The actual insurance provider, the company, backing the policy, holds the bag. They absorb the financial blow of the crash. Rasan simply takes a commission for making the highly optimized, AI-driven match between you and that provider.
It's like running a massive, highly profitable restaurant where the customer pays before the food is cooked, and someone else is actually buying all the expensive ingredients, cooking the meal, and dealing with the food waste. You just own the menu, the table, and the cash register.
That is exactly it. You own the customer interface.
Yeah.
And because they own that interface, their cash flow strategy is brilliant. They operate on an upfront cash collection model with minimal credit exposure.
Meaning they get the money first.
Yep. When you buy a policy on their app, you pay digitally before the policy is even issued. The cash hits Rasan's accounts immediately. Because of this dynamic, they operate with virtually zero working capital pressures.
Let's translate that working capital concept too. Working capital is essentially the cash a business needs on hand just to keep the lights on, paying suppliers, paying employees, keeping servers running while they wait for their customers to actually pay their invoices.
Exactly.
A lot of companies go bankrupt not because they aren't profitable on paper, but because their cash is tied up waiting for 30 or 60-day invoices to clear. But because Rasan collects cash up front from the consumer before paying out the partners, they bypass that entire waiting period.
They've achieved negative working capital. The customers fund the operations in real time. That is exactly why they rely entirely on self-financing. They have zero debt. They use zero credit facilities. It is a pure cash-generating machine.
Zero debt while facilitating 8.5 billion riyals in total subscribed premiums across their platforms. I mean, that is almost unheard of. But wait, what about their operating costs? Negative working capital is great, but they still have to pay highly skilled software engineers, build out AI infrastructure, and manage all this complex data.
This brings us to their geographic efficiency. 100% of Rasan's operating revenue comes from Saudi Arabia. That is their core market, their undisputed center of gravity.
Right.
But they don't house all their development and technical support there. They strategically use regional hubs. They have a development center in the United Arab Emirates, specifically focused on building partnerships and software architecture. And for the heavy lifting of data analytics and AI engineering, they utilize a specialized hub in Egypt.
But outsourcing development to regional hubs isn't exactly a secret strategy. Like, almost every major tech startup does that to save money, and a vast majority of them still bleed cash and require venture capital bailouts. There has to be a structural advantage beyond just geographic labor arbitrage, keeping those margins so wide.
You're right, simply offshoring isn't a magic bullet. The structural advantage lies in how they partition the work. They aren't just hunting for cheap labor, they're hunting for specialized ecosystems.
What do you mean by that?
Well, Egypt, for instance, has developed a massive, highly specialized talent pool specifically for AI and data engineering in the Mianeh region. By decentralizing their teams according to specific technical functions, UAE for corporate architecture, Egypt for AI, Saudi for product and market dominance, they maintain incredible agility.
Oh, that makes sense.
They capture premium revenue in their primary market, but protect themselves from localized economic bottlenecks by distributing their operational load.
Which totally changes their risk profile. That highly disciplined, cash upfront, decentralized model really set the stage for what happened next. Let's look at the financials, because if you trace their history, this didn't look like a rocket ship at first. It looked like a company that had hit a wall.
It really did. To understand the sheer scale of the 2025 explosion, you have to look at the tension building up in their historical trajectory. If you open their books in 2021, they posted a net profit of 35.3 million Saudi royals.
Okay, not bad.
But move forward to 2022, it was essentially flat, even dipping slightly to 34.4 million rials.
I mean, if I'm an outside investor looking at that in 2022, I'm thinking they've hit a ceiling, a total plateau.
Right. It looked like stagnation.
Yeah.
But internally, they were in an infrastructure building phase. In 2023, the spring started to uncoil. They climbed to 46 million reals. Steady, solid growth.
Okay, the momentum is building.
Then comes 2024, their breakout year. They officially listed on the Saudi Stock Exchange, the Tadawul. That IPO year, their net profit jumped to 94.7 million rials.
An incredible year by any metric. They doubled their profit, went public, and proved the model. You'd think a company would take a breath, consolidate their gains, and coast for a few quarters. But then we hit the 2025 data.
Oh yeah, hold on.
Net profit surged to 246.8 million reals. That is that 161% increase over 2024. And their top-line revenue hit 653 million reals, which is an 82% increase.
And while those raw numbers are massive, they aren't even the most impressive part of the report. Look at the efficiency. The operating profit margin jumped from 27.6% in 2024 to a staggering 38.4% in 2025.
Here's where it gets really interesting. I want you, the listener, to focus on the math for a second here. Rasan's revenue went up by 82%. But their cost of sales, the actual money they had to spend to deliver those services, only went up 57%.
Exactly.
That is the holy grail of business. How does a company actually do that? How do you scale the money coming in so much faster than the physical cost of doing the business?
Well, if we connect this to the bigger picture, it comes down to a few very specific, highly calculated drivers that all converge perfectly in 2025. You simply cannot achieve an 11-point margin expansion by just doing the exact same thing you did last year, but slightly harder.
Right, you need a different gear entirely.
Exactly. First, we have to look at sector surges. Yes, their bread-and-butter motor retail and leasing policies grew by a very healthy 21%. But the absolute star of the 2025 show was health insurance. They saw an unbelievable 94% growth in health insurance policies.
A 94% growth in a single year for health insurance. Now think about the difference between buying basic car insurance and buying health insurance. Car insurance is legally required, mostly standardized, and heavily price shopped.
Yeah, it's pretty straightforward.
But health insurance is a deeply complex product. You're dealing with deductibles, provider networks, co-pays, family inclusions. It's a whole different beast.
It is. And because it is so complex, the commissions on health insurance are significantly better, and the barrier to entry for a digital platform is much higher. Traditionally, consumers want to talk to a human broker for health insurance because it's confusing.
Right, people want their hands held.
Exactly. But Rasan had spent years refining their UI and their AI. They managed to make buying complex health coverage as seamless as buying a plane ticket.
But capturing that volume is only half the equation, right? The real magic, the reason their server costs and employee headcounts didn't skyrocket alongside that 82% revenue jump, lies in their technological infrastructure.
Oh, absolutely.
Going back to 2024, doing an IPO forces a much higher level of corporate discipline upon a company. You have to answer to public shareholders now. You can't just throw raw cash at scaling problems anymore.
Precisely. And this is where we see the payoff of their back-end transition. In 2025, they fully realized the benefits of moving to what is called dynamic containerized application hosting.
Okay, we absolutely need to translate that because dynamic containerized applications sounds like something out of a sci-fi manual.
Fair enough.
Let's use a tangible analogy here. It's like a massive municipal power grid. In the old days of tech infrastructure, if you expected a huge spike in traffic, it was like building a massive, incredibly expensive coal power plant that just sits there, idle 90% of the time, just in case there's a massive heat wave and everyone turns on their air conditioning at once.
Right, you are paying for all that wasted potential.
Exactly.
Right.
But containerization, this new model, lets them instantly rent 1,000 mini generators the exact millisecond traffic spikes. And a minute later, when the traffic drops, those generators vanish. They only pay for the exact digital electricity used.
That is a brilliant way to conceptualize it. When thousands of people log on to Temini at the exact same moment at the end of the month to renew their car insurance, the system automatically spins up these digital containers, these mini generators, to handle the load seamlessly.
And then,
When the rush is over at 2 a.m., the system scales them back down.
which mathematically explains that massive margin gap. They massively increased their data processing efficiency, meaning they could handle millions more transactions seamlessly, but they actually reduced the proportional costs associated with expanding physical hardware.
Yeah.
They didn't have to go buy and install racks of physical servers to handle an 82% jump in revenue.
That's the software economics at play. Everything they quietly invested in during that 2021 and 2022 plateau and refined leading up to the 2024 IPO, the cloud infrastructure, the AI pricing models, the app ecosystem redesign, it all finally converged and bore fruit in 2025.
It's all about timing.
Yeah, they proved they could absorb massive national-scale transaction volumes without needing to hire a proportional amount of human capital.
So basically, the cost to serve the 10 millionth customer is drastically lower than the cost to serve the first.
And because their AI models were constantly improving their pricing accuracy over time, insurers were more willing to offer premium products on their platform. They were selling higher margin products, like health and marine insurance, far more efficiently than ever before.
Wow.
That is how you expand an operating margin from 27.6% to 38.4% in 12 months. You meticulously build a machine that actually gets cheaper to run the faster it goes.
So what does this all mean for you listening right now? Whether you are evaluating a publicly traded company to invest your own money in, trying to understand the actual mechanics of the modern digital economy, or even building your own startup, Rasan offers a profound lesson in leverage.
They really do.
They prove that capturing the digital customer interface, becoming the seamless, frictionless layer between the consumer and a highly complex, highly regulated product is incredibly valuable. If you can own that interface and let your partners take on the heavy physical assets and the terrifying underwriting risks, you have a recipe for exponential cash generation.
It really is a paradigm shift. They facilitated over 8.5 billion rials in total subscribed premiums moving through the Saudi economy, but they kept their own balance sheet impossibly light.
It's just wild to think about.
But this raises an incredibly important question. Where on earth do they go from here? I mean, they have practically conquered the digital insurance brokerage market in Saudi Arabia.
Sure.
They have virtually zero debt. They are sitting on massive cash reserves generated by upfront digital payments, and they possess an AI-driven platform that scales flawlessly without proportional cost increases.
Which brings us to a final provocative thought I want to leave you with today. If you dig deep into the back pages of this 2025 annual report, buried in the corporate updates is a mention of a brand new subsidiary.
Oh yeah, this is a really big news.
Rasan received initial approval from the Saudi Central Bank to establish a wholly owned company called Nextfin Solutions. Its stated purpose: digital finance brokerage.
Which is a massive signal. They're stepping out of the confines of just insurance and moving directly into the wider, incredibly lucrative world of financial technology.
Yep.
They're going to take their exact proven model and apply it to financing.
Exactly. Think about the gravity of that. Rasan achieved this level of hypergrowth, a 161% profit jump, and absolute market dominance, just by being the digital middleman for insurance policies. What happens to the entire financial landscape when they take this exact same asset-light, AI-driven, zero-gravity model and unleash it on the world of loans, credit, and financing?
It's going to shake things up.
If they can use their AI and seamless UI to eliminate the friction of borrowing money the exact same way they eliminated the friction of buying health insurance, we might be looking at a fundamental shift in how credit is accessed across the entire region.
It is a fascinating and highly disruptive prospect. If Nextfin Solutions can replicate even a fraction of Tamini's success, the staggering financial growth we just dissected in 2025 might genuinely just be the warm-up act.
Suddenly, that old industrial model with all its financial gravity, heavy assets, and massive debt seems incredibly outdated, doesn't it? Thank you so much for joining us on this deep dive. Keep questioning the physics of the businesses around you. We'll catch you next time.